all this easy money, lower, lax lending standards. This is all going to be more inflation. It's going to lead to more quantitative easing, money printing, a weaker dollar, right? All of this is bullish for gold and silver. That's why the prices are going up, right? And that's why they're going to keep going up this week. Gold, is a little bit further from its high. Gold still has a couple of $100 to go because gold, I think, almost hit 5,400.
Yeah. On a net present value basis, at $4,000 gold is cheaper than it was before it doubled at $2,200 gold. So at my age, the idea that I increase my risk for marginal reward is stupid. When people's earnings forecasts are based on $2,750 gold and $3,000 gold, and they're selling the stuff for $4,000, there's pretty good earnings surprises. And earnings surprises drive share prices.
Are generally very swift. Maybe they're shallow and they're over with. A lot of people who probably bailed out aren't back in yet. And the next thing they know, we're going to be at record highs. Now, certainly in the metals themselves. I mean, silver can easily hit a new record high this week. Gold, is a little bit further from its high. Gold still has a couple of $100 to go because gold, I think, almost hit 5,400. So we need a bigger rally in gold than we do in silver. But they're both likely to make new highs. And I'm going to get into some of the fundamentals because there were a lot of very bullish news items that we were getting in the market. I mean, of course, one of them, I think, is the end of the government shutdown. I mean, I mentioned that on the last podcast that it looked like it was getting likely that the shutdown would end. And by Monday morning, it was pretty much a done deal. And that was really the catalyst for the $100 rise in the price of gold. $100 plus was the end of the government shutdown. Now, a lot of people might have thought intuitively, well, wouldn't that be bad for gold? I mean, wasn't gold going up because the government shutdown was bad for the economy? It was creating uncertainty and that was benefiting gold. And so that once that uncertainty was behind us, once the government reopened and that was good for the economy, that would hurt gold. That's what a lot of people might have thought. But the opposite happened because the government reopening isn't bad for gold. It's the government staying open that's bad for gold. Because when the government is open, it's doing bad stuff. It's spending a lot of money. It's borrowing a lot of money. It's printing a lot of money. The problem with the shutdown was we didn't shut down enough government. Maybe if we shut down a lot more government, that might have been bad for gold. But the fact of the matter is it's business as usual in Washington, D.C., and that's good for gold because it means the reckless spending is going to continue. The money printing is going to continue. And so inflation is going to get worse. The dollar is ultimately going to crack. And all of this is bullish for gold and bullish for silver. Tech stocks are going down. Crypto is going down. But this is all dangerous stuff for the financial sector. But all this is great for gold and silver because what is all this easy money, lower, lax lending standards? This is all going to be more inflation. It's going to lead to more quantitative easing, money printing, a weaker dollar, right? All of this is bullish for gold and silver. That's why the prices are going up, right? And that's why they're going to keep going up. And in the meantime, the markets have not reacted. They're still shell-shocked from that correction. And they haven't realized, like I just said, silver was only higher than it is right now on one day, and it was barely higher. Yet you have all these stocks that are in bear markets because of that, right? So it's not going to be long. All those silver stocks, I think, are going to make new highs. Gold stocks, some of them have made new highs. Barrick Gold made a new high. Their earnings came out on Monday. Again, blowout earnings, record revenue, raised the dividend. The stock's up about maybe 13% in the last 3 days. and it's at a new high, so it took out its high. I noticed IM Gold, another stock we have in our value fund. That stock hit a new record high today, or I don't know if it's a record going back, but 52-week high. So some of these stocks have taken out their highs, but the vast majority of stocks are still significantly below where they were when gold and silver prices were not that much higher than they are right now. But it's just that fear entered the market, and it's just taking a little bit of time for that to go away. People have a memory of that. But again, that's what the markets are doing. They're trying to check the enthusiasm.
That because of the size of the on-balance sheet and off-balance sheet liabilities of the U.S. government, relative to the size of the U.S. economy, that the purchasing power of the U.S. dollar will decline by 75% over 10 years. If that's true, and I believe it is, I'd love to see somebody challenge my arithmetic, it is likely, as far as I'm concerned, that the nominal price of gold reflects the deterioration of the purchasing power of the U.S. dollar. That would suggest over 10 years a threefold increase in the price of gold. Is it going to happen? I don't know. But it's arithmetically logical that it would occur. The second thing is that gold traditionally has done well, reflecting that fear in real interest rates. If you believe in the CPI, you believe that the deterioration of the US dollar is proceeding along at 2.9% a year. The problem is that the CPI is a flawed index. When I look at the basket of goods and services that I consume, the deterioration of the US dollar relative to what I buy, what my household buys, is declining in purchasing power at about 8%. So if you buy the US 10-year paying 4.1 in a currency that's declining by 8, what that means is that you're losing 3.9% a year compounded. There is nothing that could make you more concerned about the maintenance of the purchasing power of the dollar than a guarantee that your savings cost you 4%. Hence, gold does well.
Yeah.
On a net present value basis, at $4,000 gold is cheaper than it was before it doubled at $2,200 gold. So at my age, the idea that I increase my risk for marginal reward is stupid. There's a lot of room for surprise.
Yeah.
The mining companies have also been trained to use fairly conservative price forecasts. When people's earnings forecasts are based on $2,750 gold and $3,000 gold, and they're selling the stuff for $4,000, there's pretty good earnings surprises. And earnings surprises drive share price escalation. I think there are good as opposed to bad surprises baked in the cake for at least 2 more quarters.
We're on the right track.
Now, what we are seeing is we're beginning to see pretty ugly cost creep. And I suspect what we're beginning to see is payback for prior year's high grading. What happens when you high grade is that you artificially goose earnings in that quarter, depending on how you report, but you also sterilize the ore around what you high graded. So I think part of the cost escalation that we're seeing now is payback for hidden sin, but we'll work through this. Liquidity. People pay more attention to liquidity than they do solvency because people hate arithmetic. If you look at the S&P 500 in the period 2000 to 2025 and your denominator is gold rather than the dollar, the S&P 500 has been in a bear market for 25 years. If your denominator is fraudulent, then you see us in a bull market. I mean, this is really pretty simple arithmetic.
It is.
I have, as an example, I've maintained liquidity in US dollars, but I've saved in gold for 25 years. And when I look at the part of my ledger that's constructed in gold, I'm struck by how cheap things are. Energy's cheap, food is cheap, housing's cheap. What I use as my denominator, the US dollar, things are expensive.
Yeah.
The Fed is actively participating in the short end of the curve. Since